You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the deep dive. We're the place where we try to slice through all the noise and really unpack the key insights from the sources you send us. And today, we're digging into a question that, well, it seems like it's on everyone's mind whenever the market feels a bit choppy.
Yeah, that big question.
Exactly.
Yeah.
What actually happens with dividend stocks when, uncertainty really ramps up?
Yeah, and we've got a really great source document today that goes deep on this.
Yeah.
It looks at the mechanics, the history,
Right.
and importantly, how you can actually use this stuff strategically.
Totally. Just think about the past few years. You've got inflation concerns, interest rates shifting around, global events. Yeah. It's volatile.
Definitely.
And in that kind of environment, the idea of getting like a steady cash payment from your stock sounds pretty good, doesn't it?
Oh, absolutely appealing. But the question is it always that simple? Is that income stream really a solid rock when things get stormy?
That's the core of it.
And it's more complex than just finding the biggest yield number. The source material really breaks down why they might act differently, but also, crucially, that not all dividend stocks are created equal in these situations.
Right, that's a key point. So we're going to pull apart how they work, maybe look at some real-world history from recent shaky time.
Some case studies.
And give you a framework. A way to think about finding opportunities when the market feels like, well, a roller coaster.
Sounds like a plan.
Okay, ready to jump in. Let's unpack this. All right, so let's start with the basics. What exactly are dividend stocks, fundamentally? And, why might they behave differently when things get uncertain?
Okay, so simply put, dividend stocks typically come from more mature, profitable companies. Businesses that decide to distribute a part of their earnings back to shareholders.
Usually as cash payments, right, the dividend itself.
Exactly.
Yeah.
Cash dividends. These aren't usually your, hyper-growth startups focused only on reinvesting everything.
Gotcha. And the why? Why might they be different in uncertain markets? That income piece feels like a big factor.
Oh, it's huge, yeah. Because when stock prices are bouncing all over the place, that dividend check is, it's a tangible return.
Right. You actually get the cash?
You get the cash, regardless of the price swings that day or week. It creates this sort of buffer, a dividend cushion.
The cushion, okay.
So if a stock yields, say, 4%, you're getting that 4% income stream. And that helps offset, at least partially, any temporary drop in the stock's price itself.
So it kind of pays you to wait through the volatility. Makes sense. What about the companies themselves, the underlying businesses?
That's the other really important part. The source points out these companies often operate in more stable sectors. They tend to have more predictable revenue.
Like what kind of sectors?
Think utilities. People always need electricity, water, consumer staples, groceries, household goods, things people buy even in a recession.
Right. Non-negotiables.
Exactly. Or even certain types of REITs, real estate investment trusts, that own essential infrastructure, cell towers, data centers, things like that. Demand holds up better.
Okay, so you've got the cash buffer, often more stable businesses. Is there a psychological angle too? Like who invests in these?
That's a great point the source touches on. Yeah. Investors who focus on dividends are often thinking long-term. Maybe they want retirement income, steady wealth building.
Not just quick trading gains.
Exactly. And that long-term mindset usually means they're less prone to panic selling when the market gets rough.
So the investor base itself might add some stability?
It can contribute, yeah. Less knee-jerk reactions, maybe.
Interesting. But you mentioned earlier, it's not all dividend stocks that offer this resilience.
No, and this is absolutely critical from the source. Just paying a dividend isn't a magic shield. You really need to dig deeper.
Go beyond just the yield percentage.
Way beyond. You need to look at the quality of that dividend and the company behind it.
Okay, and that leads us perfectly into what the source calls the quality dividend framework. This sounds like the way to sort the good from the, maybe not so resilient.
That's exactly it. It's a structured approach. Looking past just the headline yield number, it's built on 4 key components, 4 pillars.
Pillar 1, dividend sustainability.
I guess this is the big one. Can the company actually keep paying?
Absolutely fundamental. A high yield today means nothing if it gets slashed tomorrow. So how do you check this? One common metric is the payout ratio.
Which is?
Basically, the percentage of the company's earnings that it's paying out as dividends. Generally, a ratio below, say, 60% or 70% is seen as healthier.
Leave some wiggle room.
Right. Room for earnings to fluctuate without immediately threatening the dividend. But the source notes this varies by sector. Utilities might naturally have higher payout ratios because their earnings are usually more stable, whereas a more cyclical company, like in manufacturing or something, probably needs a lower payout ratio for safety. And the source emphasizes looking beyond just earnings, something about cash flow.
Yes, free cash flow, or FCF. This is arguably even more important. FCF is the actual cash the business generates after paying for its operations and investing in its future.
Okay. Why is that better than earnings?
Well, accounting earnings can sometimes be, let's say, managed or influenced by various accounting rules. FCF is much harder to fudge. It's the real cash coming in and going out.
Got it.
So if a company consistently generates more free cash flow than it pays out in dividends, that's a really strong sign the dividend is sustainable, very secure.
Makes sense. Okay, sustainability is pillar 1. What's pillar 2?
Pillar 2 is dividend growth history.
Not just paying, but increasing the payment over time.
Exactly. Does the company have a track record of consistently raising its dividend year after year? This tells you a lot.
Like the dividend aristocrats.
Precisely. The source mentions the S&P 500 dividend aristocrats companies with 25 or more consecutive years of dividend increases. Historically, they've shown remarkable resilience during downturns.
Why is that history so revealing? It's more than just getting a bigger check, isn't it?
Oh, much more. That track record, that long history of increases, it signals real underlying strength in the business model.
How so?
Well, it suggests management is confident about the future. It shows a commitment to returning value to shareholders. And fundamentally, it usually means the company has been successfully navigating economic cycles for a long time.
Right. They've seen downturns before and kept raising.
Yeah, exactly. It often points to durable competitive advantages, those moats people talk about, or pricing power. The ability to raise prices allows them to grow profits and fund those rising dividends, even when the economy isn't booming.
Okay, got it. So sustainability, growth history, pillar 3.
Pillar 3 is business model resilience. Basically, are some businesses just naturally better equipped to handle uncertainty?
And the answer seems to be yes.
Yes. The source again highlights those defensive sectors we touched on. Utilities, consumer staples, healthcare. Demand tends to hold up better. But it's also about those competitive advantages, the moats, within any sector. The example given is Microsoft.
Right, their software ecosystem.
Yeah. Businesses are so reliant on their software, their cloud services. It creates very sticky, recurring revenue. That provides a lot of stability, even if the wider tech sector hits a rough patch.
Makes sense. And the final pillar, number 4.
Financial strength. Basically, how solid is the company's balance sheet?
This sounds critical when things get uncertain.
Absolutely vital. You want companies with reasonable debt levels, good credit ratings, plenty of liquidity cash on hand.
And what does that strength allow them to do?
It gives them options, flexibility. They can keep paying the dividend even if earnings dip temporarily. They might be able to invest in growth or R&D when their weaker competitors have to pull back.
Or maybe even buy struggling competitors.
Potentially, yeah. Make opportunistic acquisitions. Essentially, a strong balance sheet positions them not just to survive a storm, but maybe even emerge stronger on the other side.
Okay, so that framework, sustainability, growth, resilience, financial strength, gives us a really solid checklist. Now, let's see how it played out in reality. The source has some fascinating historical examples, right?
Yeah, looking back at recent periods of market stress is really insightful. The 2008 global financial crisis is maybe the ultimate stress test in recent memory.
Right. The whole market just cratered. The S&P 500 was down, what was it, around 37%?
Something like that, yeah.
Sure.
A massive drop. But here's where that quality factor really shows up. Those S&P 500 dividend aristocrats we mentioned.
The ones with the long growth history.
Exactly. They also fell, of course, but significantly less. Their decline was closer to 22%.
Wow, that's a 15 percentage point difference. That's huge.
It's a really striking difference. Now, the source is careful to point out this wasn't true for all dividend stocks. You couldn't just buy anything paying a dividend and expect protection.
Right. Which sectors got hit hard despite paying dividends?
Financials, obviously. Banks, insurance companies, many were forced to cut or eliminate their dividends entirely. Some REITs also struggled significantly.
So the sector and the individual company's health were paramount, even within dividend payers, who did hold up well in '08, according to the source.
It was largely those classic defensive sectors.
Yeah.
Consumer staples did well. Think Procter & Gamble, Coca-Cola, Walmart. They generally maintained or even grew their dividends.
People still needed soap and soda.
Pretty much.
Yeah.
Utilities and many healthcare companies also proved quite resilient during that period.
Okay, let's jump forward. 2020 and the COVID-19 pandemic, a totally different kind of shock, right? A sudden global shutdown.
Completely different dynamic.
Yeah.
And you saw a really stark divergence in performance because of it.
How so?
Well, sectors that were directly slammed by the lockdowns, travel, airlines, hotels, restaurants, even energy, as demand collapsed, they saw widespread dividend cuts and suspensions very quickly.
Makes sense. But who held up?
Companies whose business models weren't as impacted or maybe even benefited. Certain tech companies that paid dividends did well. Consumer staples, again, saw demand hold up, even surge in some areas.
Pantry loading.
Exactly. And healthcare remained essential. The source also notes how the pandemic actually accelerated trends that benefited some dividend payers.
Like what?
Think about data centers, cell towers. The need for digital infrastructure just exploded with remote work and streaming. This reinforced their sort of utility-like, reliable cash flows.
Interesting. Okay, one more recent test. 2022, we had soaring inflation, rapidly rising interest rates. What happened then? Conventional wisdom says rising rates are bad for dividend stocks.
Yeah, the thinking is that bonds become more attractive competitors for income, so dividend stock prices should fall.
But was it that simple?
Not entirely. The source suggests it was more nuanced. What really mattered was pricing power.
The ability to pass on cost increases.
Exactly. Companies that could raise their prices to offset inflation without losing customers tended to hold up much better.
Who fit that bill?
Again, often consumer staples with strong brands. Utilities that could get regulated rate increases approved. Basically, companies with strong competitive positions.
And who struggled in that rising rate environment?
Generally, it was the higher-yielding stocks without strong pricing power, and particularly those in interest rate-sensitive sectors.
Like some REITs again, or utilities with lots of debt.
Exactly. They got squeezed from both sides, rising borrowing costs, putting pressure on their finances, investors worrying if those high dividend payouts were sustainable as rates climbed.
Wow. Looking at those specific periods really drives home why that quality framework matters so much. It's not just theory. Okay, let's pivot a bit and look more closely at some of the key sectors the source flags as relevant here.
Sure. Utilities are often the first ones people think of, right?
Definitely. Why are they considered defensive?
Well, they provide essential services: electricity, water, gas. Demand is relatively stable. Plus, many operate under regulated models, which can lead to predictable cash flows and often allow for gradual rate increases over time to cover costs and investments.
But as we saw in the examples, they're not all the same, are they?
No, definitely not. Some utilities face more competition, particularly in power generation. Others might have taken on a lot of debt, making them more vulnerable to interest rate hikes. And then there's the whole clean energy transition. It's a massive opportunity for investment, but it also creates uncertainty and requires huge capital spending for traditional utility models. So you need to look closely.
Okay. What about consumer staples? The everyday stuff.
Yeah, think P&G, Johnson & Johnson's consumer side, Coca-Cola, PepsiCo. Their defensiveness comes from selling things people need, or at least consistently want, regardless of the economic climate.
And their strengths.
Often, it's powerful brands that command loyalty and allow them some pricing power. Many are globally diversified, which helps smooth out regional bumps. They tend to be very focused on managing costs and maintaining profit margins.
Which supports stable cash flows for dividends.
Exactly. Allows them to maintain and often grow those dividends pretty reliably.
Healthcare seems like an interesting blend of defense and growth.
It really is. You've got pharmaceutical companies with diversified drug portfolios and ongoing research pipelines. You have medical device makers providing essential tools. Demand is underpinned by basic health needs, making it defensive. But you also have significant long-term growth potential, driven by aging populations worldwide and ongoing medical innovation. It's a compelling combination.
And technology, we mentioned Microsoft earlier. It's not just growth anymore.
No, the tech landscape has really matured. You now have giants like Microsoft, Apple, Cisco, even some semiconductor companies that are highly profitable, generate enormous amounts of free cash flow.
And have started paying dividends.
Exactly.
Yeah.
And often growing them quite nicely. They've built dominant market positions, often with significant recurring revenue streams from software or services. Their balance sheets are frequently fortress-like. So while their stock prices can certainly be volatile, the dividends themselves are often very secure.
Okay, last one here, REITs. They're kind of a special case, right? Because they have to pay out most of their income?
They do. That's part of the structure, which often leads to higher yields, attracting income investors.
But also more sensitivity.
Yes, generally more sensitive to interest rate changes and the overall health of the economy impacting their specific property types. The source really highlights the need to differentiate within REITs.
Right.
Well, during uncertainty, REITs owning things like data centers, cell towers, healthcare facilities, or maybe industrial warehouses and grocery-anchored retail centers tend to be more resilient
Compared to,
say, office buildings facing work-from-home trends, or traditional shopping malls or hotels, which are much more cyclical. So you really have to understand the underlying properties.
Okay, so we have the quality framework, we've seen the history, we've looked at key sectors. How do you actually take all this and, build a resilient dividend portfolio for these uncertain times?
Right, putting it into practice. I think the first principle, maybe the most important, is thoughtful diversification.
Sounds fundamental, but easy to get wrong.
Very easy. You absolutely need to avoid piling into just one or two sectors, even if they seem defensive. Remember 2008 and the financials.
Right. Too much concentration, even in dividend payers, can burn you.
Exactly. So spread your bets. A core satellite approach, mentioned in the source, can work well here.
How does that work?
You build your core portfolio around those super high-quality, long-term dividend growers, the aristocrats, the dividend queens companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, maybe Microsoft now fits in there. Companies proven through cycles.
Okay, that's the stable core. What about the satellites?
The satellites are where you add diversification and maybe a bit more targeted exposure. This could be select REITs in those resilient subsectors we talked about, or some international dividend payers, perhaps even companies involved in growing areas like renewable energy infrastructure that have long-term contracts.
Got it. What about yield itself? We know not to chase the highest yield, but where does it fit in? Is there a sweet spot?
Yeah, you need to balance yield against the risk and the sustainability. That super high yield is often a red flag, remember?
The yield trap.
Exactly. The source suggests that for established quality companies, a yield somewhere in the, say, 2% to 5% range is often a reasonable area. It provides meaningful income, but it's usually not so high that it signals deep trouble or an imminent cut.
Okay. And geographic diversification, getting exposure outside your home country.
Another good layer of diversification, yeah. Different economies move in different cycles. Currency exposure can sometimes help and hurt.
Examples?
The source might mention stable European utilities. Some Canadian banks are known for dividends, maybe specific telecoms in emerging markets.
But there are complexities.
Definitely. You have to consider withholding taxes on foreign dividends. Currency fluctuations can impact your returns. For many investors, using international dividend ETFs is probably the simplest way to get that exposure without the individual company headaches.
Right. And one last point here, timing. Trying to perfectly time the market, especially when it's volatile, seems like a losing game.
Almost always is, which is why dollar cost averaging, or DCA, is such a valuable strategy here.
Explain that again quickly.
It just means investing a fixed amount of money at regular intervals, say every month or every quarter, regardless of whether the market is up or down.
And the benefit.
When prices are lower, your fixed amount buys more shares. When prices are higher, it buys fewer. Over time, it smooths out your purchase price and, crucially, ensures you're buying more shares when quality companies are potentially on sale during downturns. It takes the emotion out of it.
Okay, that makes sense for building positions. But even with a good plan, it seems like there are common mistakes people make with dividend investing, pitfalls to avoid.
Oh, absolutely. And the source highlights a few big ones. Top of the list, the most dangerous one we keep mentioning, the yield trap.
Chasing that huge percentage.
Exactly. Seeing an 8%, 10%, 12% yield and just diving in without asking why it's so high.
And the reason is usually bad news.
Often, yeah. It usually means the stock price has fallen sharply because the market expects bad things, declining business, maybe a dividend cut is likely. The yield looks high based on the last dividend paid and the new low price. If they cut the dividend, you lose the income, and the stock price probably falls even further. It's a double whammy.
So always question the super high yield. Got it. What's another pitfall?
Sector concentration. We touched on this. Getting way too loaded up on, say, just utilities or just REITs because they seem safe or have high yield.
Right, they have their own risks.
They do. Rising interest rates can hit them hard. Regulatory changes can impact utilities. Specific issues like work from home affect office REITs. You need broader diversification than just one or two safe sectors.
Okay. Another one, ignoring total return.
Yeah, this seems odd, but people can get so focused on the dividend income that they forget about the stock price itself.
How does that play out?
Well, getting a 5% dividend yield doesn't feel great if the stock price drops 20% that year. Your total return is negative 15%. Right. The goal should be investing in quality companies where, yes, you get the dividend, but there's also a reasonable expectation that the underlying business is strong enough for the stock price to hold up or appreciate over the long term. Total return income plus price change is what ultimately matters.
Makes sense. Timing mistakes.
Trying to be too clever with buying and selling quality dividend stocks in a panic when the market dips, just when that income might be most valuable.
Or jumping in too early in a downturn.
Yeah, trying to perfectly call the bottom. Again, dollar cost averaging helps avoid these timing errors. Just keep investing steadily in your quality names.
And finally, taxes. Easy to forget.
But important. Dividends are typically taxed as income in the year you receive them, unlike capital gains, which you only pay when you sell.
So holding them in tax-advantaged accounts helps.
Definitely. Things like IRAs or 401ks can defer or eliminate taxes on dividends, which makes a big difference over time. Also, understanding qualified versus non-qualified dividends, as they can be taxed differently, it's worth considering the tax implications.
Okay. For listeners who really want to get into the weeds, the source also mentions some more advanced strategies or considerations.
Yeah, a few finer points. One is looking closely at the dividend growth rate itself.
Not just that it grows, but how fast.
Exactly. Is the company growing its dividend by, say, 2% a year or more like a 10%? And critically, is that growth rate supported by similar growth in earnings and free cash flow? A healthy, sustainable growth rate adds significant compounding power over the long haul.
Okay.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
What about option strategies? Covered calls, cash-secured puts.
The source mentions them, but with a note of caution. These can be used to potentially generate extra income, covered calls, or acquire shares at a lower price, cash-secured puts.
What?
But they add complexity and introduce different kinds of risk. A covered call limits your potential upside if the stock price shoots up. Puts require having the cash ready to buy if assigned. These are really for more experienced investors who fully understand the mechanics and trade-offs involved.
Got it. Not for beginners. What about DREP's dividend reinvestment programs?
These are powerful and relatively simple. Most brokers offer them. It just means your cash dividends are automatically used to buy more shares or fractional shares of the same stock.
And that's especially good in downturns.
Yeah, because when the stock price is lower, your reinvested dividend buys more shares. It automatically accelerates your compounding, especially during volatile periods. Simple, but effective.
International considerations again?
Just reiterating the complexity tax treaties, different accounting, economic cycles, and again, suggesting that for most people, international dividend ETFs are often the most practical way to get that exposure.
And finally, this idea of ESG integration, linking environmental, social, governance factors.
Right. The thinking here is that companies managing ESG factors well might actually be more sustainable businesses long-term.
How so?
Well, good governance reduces risks of scandals.
Yes.
Managing environmental impact can avoid fines or operational disruptions. Strong social policies might lead to better employee retention and brand image. All these things can contribute to more stable, reliable cash flows over time, which ultimately supports dividend sustainability. It's about long-term risk management.
Okay, let's bring this right up to the present moment, or at least the mid-2025 context from the source material. What are the big environmental factors shaping things for dividend investors now?
Well, a few key things stand out. We're still in an environment of somewhat elevated interest rates compared to the ultra-low rates we had before.
Meaning bonds are more competitive for income.
Exactly. Bonds offer higher yields than they did for years, so income investors have alternatives. This puts pressure on dividend stocks to offer attractive yields and growth.
And inflation. Still a concern.
Seems to be lingering, which makes dividend growth particularly valuable, right? You want that income stream to keep pace with, or ideally beat, inflation to maintain your purchasing power.
Geopolitical tensions are still simmering too, adding uncertainty.
Always a factor, unfortunately. And then there's the huge impact of technological disruption accelerating rapidly. The source specifically calls out AI, artificial intelligence.
As both an opportunity and a threat.
Precisely. For some companies, AI could boost efficiency, create new products and services, maybe free up cash flow for dividends. For others, their business models might be fundamentally challenged or even become obsolete. It's a massive wave of change.
And climate change and the energy transition.
Huge implications across sectors. Traditional energy companies face long-term headwinds and pressure to adapt, but it also creates enormous investment opportunities in renewables, grid modernization, battery storage, potentially new sources of dividend income, often with long-term contracts providing some stability.
Demographics playing a role too, like aging populations.
Definitely. Drives long-term demand for healthcare, as we mentioned, but it can also create labor shortages or workforce challenges in other industries. And of course, the regulatory backdrop, taxes, environmental rules, financial regulations, that's always shifting and can impact different sectors.
So with all these swirling factors, what's the key takeaway for navigating the future?
I think the main message is flexibility and a continued focus on quality. You need companies with strong competitive positions that allow them to adapt, businesses with resilient models, and crucially, management teams focused on long-term value creation, not just chasing short-term trends. Adaptability is key.
All right, this has been incredibly comprehensive. Let's wrap up by giving our listeners some really concrete, actionable steps they can take based on everything we've discussed.
Okay, practical steps. First, maybe assess what you already own. If you hold dividend stocks, run them through that quality dividend framework we talked about.
Sustainability, growth history, business resilience, financial strength.
Exactly. How do your current holdings measure up? It's a good starting point.
Second, use the tools available to do your research.
Right. Don't just guess or go by headlines. Use financial websites. Read company investor relations reports. Use the screening tools your broker provides. The data on payout ratios, free cash flow, dividend history, debt levels. It's all out there. You just need to look.
And if picking individual stocks feels like too much,
Then definitely consider fund options. Dividend-focused ETFs or mutual funds can give you instant diversification and professional management.
what should you look for in a fund?
Look at its strategy. Is it focused on high yield, dividend growth, quality? Check its track record, especially how it performed during past downturns. And pay close attention to the expense ratio, keep costs low. The source mentioned examples like Vanguard's VIG or State Street's SDY, but there are many others. Do your homework on the fund itself.
Okay, and setting realistic expectations seems crucial.
Absolutely. This isn't a get-rich-quick scheme. Quality dividend investing is usually about steady income and compounding wealth over the long term. The goal is often better risk-adjusted returns, meaning potentially smoother performance through market cycles, not necessarily beating the hottest stocks every year. Patience is really important.
Monitor and rebalance, but don't obsess daily.
Exactly. Check in periodically, maybe quarterly when earnings come out. See if anything fundamental has changed with your companies. Rebalance your portfolio back to your target allocations if needed, but don't react to every market wiggle.
Integrate tax planning.
Yep. Think about where you hold your dividend stocks, taxable account versus IRA or 401k. Understand the potential tax drag and plan accordingly.
And let's mention dollar cost averaging one more time.
Such a valuable tool, especially when markets feel uncertain. Invest consistently, take the time and guesswork out, and benefit from buying more shares when prices are lower. It's a disciplined approach.
So wrapping this all up, it feels like the big message is that dividend stocks can be a really valuable part of a portfolio, especially when markets are choppy.
They can offer that stability and income.
But it's not automatic. You can't just buy any stock with a yield.
No, definitely not.
Sure.
It really comes down to focusing on quality over just the yield number itself, applying that framework we discussed.
Right. Dividend sustainability, a history of growth, a resilient business model, and solid financial strength.
And diversification is key too. Across sectors, maybe geographies, don't put all your eggs in one basket.
And keeping that long-term perspective, remembering why you invested in the first place, even when things feel chaotic.
Exactly. Uncertain markets are normal. They happen. Having a plan, focusing on quality, and staying disciplined are how you navigate them successfully.
These quality dividend payers, the ones that can maintain and grow through thick and thin, they often represent really durable businesses. They won't make your portfolio immune to volatility.
Nothing does that.
But they can provide that income stream and potentially smooth out the ride, offering better risk-adjusted returns over time.
Yeah. So whether you're looking for income now or building wealth for the future, or maybe a bit of both, quality dividend stocks really do deserve consideration within a well-thought-out, diversified portfolio. Just approach it with knowledge and patience.
Okay, a fantastic deep dive. Before we go, here's that final provocative thought for you to chew on. We talked about all the massive shifts happening: AI, climate change, demographics. Given that accelerating pace of change, how might our very definition of what makes a dividend truly sustainable and a company truly resilient need to evolve in the coming years? What does long-term durability look like in that future?
Something to think about. That wraps up this deep dive.
Indeed it does. Until next time, keep learning and keep investing wisely.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.